Hello, everyone. Welcome to the show. Today on the final bar, my guest is Jeff Hughes from JWH Investments outside of Minneapolis, Minnesota, hopefully helping us make sense of this market that continues to confound and confuse and excite and create despair and do all the things that volatile bear market rallies tend to do. Love to dig into to the thinking there on terms of where we're at relative to this bear market rally. Also, we'll fish for alpha. We're looking for some buy ideas in this sort of environment. Ladies and gentlemen, this is the final bar. Good afternoon, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a surprisingly rainy Redmond, Washington. Good to have you with us every weekday after the close to break down the action of the day, to try to get our heads around what's happening using price as our guidepost, as our illustration, our visualization of market psychology and investor behavior. The goal, as always, is to take the short-term movements of today and connect it to the long-term trends, try to make sense of how this fits into the big picture, how the big picture is evolving. And now as we get to, what I would argue sort of the mature part of this bear market rally, it's all about the inflection point, how things evolve, what is leading on the way up, what is leading on the way down, what struggles, what emerges as new leadership. And hopefully we'll try to answer some questions about that today. Now, coming up, we have some great guests today. As I mentioned, we have Jeff Hughes, who's a fantastic analyst and strategist to give us his take. Tomorrow, we have Tony Dwyer from Canaccord Genuity joining us on the show. Next week, we have two great guests, Craig Johnson on Tuesday from Piper Sandler in Minneapolis, and we have Todd Sohn from Strategas joining us from New York on Wednesday the 29th. Two other things to point out. We have our interview style show every Monday, and Todd Gordon is going to be joining us next on Monday. A great trader, a great speaker to market dynamics, especially on the short term. So you're not going to want to miss his discussion about how he incorporates charts into his process. And then also we have a new show. We did a sort of a test run a couple weeks ago on a show called The Pitch, where we have three analysts, three strategists join us, and each get to pitch 5 individual charts as ideas for the coming weeks. And we are turning that into a monthly broadcast. So the next one's going to be on May 13th, and it's going to be hosted by our own Grayson Rose. So 3 analysts, 3 separate analysts pitching their ideas, and then as a group discussing some general themes and takeaways from it. It was a really, really cool first try, and we're excited to keep building on that theme and take some of your feedback to heart. Let's get to our market recap today. So, today was certainly a bit of a recovery after the last couple days. Yesterday, it felt like the breakdowns were jumping off the page of me, and even into this morning, looking at the charts again before the open, certainly felt like this distribution, these bear flags across the board in so many different markets all breaking down. Today, we sort of rebounded from that. So anytime you get a big breakdown, like I think we saw yesterday, for me, it's all about the follow through. It's all about the next day, and you get a confirmation. And I've used that for a while. I'm trying to think about where I learned that. I remember talking with Tom DeMark years ago about the importance of follow through. And he was very big on a signal occurs, but then you need to get the validation, the confirmation from the next day, the next bar. And many analysts have had that sort of approach. But I remember talking with him a lot about just philosophically why that made sense. And I think today is one of those examples where you had the breakdown yesterday, you had a bit of a pullback today, a bit of a reaction rally. And so the question now is, obviously, do we follow through now and continue the move lower? Is this just a quick pause to digest yesterday's breakdown, or was yesterday's breakdown a false one? Again, you see as things emerge which way things are headed. For most of the day, it was certainly a period of accumulation, gapping up out of the open, then a nice little accumulation. We sold off a bit into the close, so the S&P still finished up 2 1/3% almost, but finished just below 2,800, kind of closed back below it. It was at the highs of the day not too long ago. It's a little bit of a distribution, but overall still very positive. Worth noting, mid cap and small cap up a lot less. So 1.5% for the mid caps, 0.9% for small caps. The VIX now back down to just below 42, but still again in a fairly elevated position. Let's look at a chart of the S&P 500. We'll refresh it here for the closing prices, and almost to the tick, we're about at the 50% retracement between the high from February, the low from March. We are literally almost exactly 50% of the way on today's close, and 2,800 has really been a central point to pay attention to. So again, we're coming out of that sort of that area where I mentioned I did a webcast for the CSTA in Toronto, the Canadian Society of Technical Analysts, and was supposed to go there in person, but as with many things, we rescheduled it as a virtual chapter event. One of the things I talked about is if you had heard about the sell-off and then wanted to figure out where a bear market rally would go to, and you took a crayon, I'm pretty sure I would draw to around 2,850, 2,900, because that's sort of in that range between 50 and 62% of retracing that overall sell-off. And so that's kind of where we're at. The breakdown yesterday is what pushed us back below this trend line. A lot of charts had that. So we're still below that trend line on a lot of charts, but a bit of a bounce today. So again, I think what's going to happen is we either finish the week weaker and breaking down through Tuesday's low, or we continue to recover. We go back to the peaks from the end of last week. And I think that'll tell us a lot about where we're at and if this bear market rally is at its end, or if it's going to continue to chop around a bit. Let's look at some other quick themes here. So from a sector perspective, it was very interesting to see technology leading the way higher, up almost 4%, a little bit around there earlier, but settling in very nicely as the top sector for the day, followed by energy, followed by utilities. So this was not a step on the gas, all the things you'd expect to be rallying in bull market mode popping up there. Sort of a mix of a search for yield, the recovery of energy stocks off of a very beaten down oil price, all of those sorts of things. On the bottom side, you have consumer staples, up, but up the least, and the weakest performer of the 11 sectors, followed by industrials, followed by financials, followed by healthcare. So financials and healthcare are two really interesting ones. We talked earlier in the week on Monday. We have the sector setup, so we're looking at the sector charts. But I think some of these sectors are just at really key points. And I always am looking for sort of one chart to focus on. The chart of healthcare is a really interesting one. It's recovered so much more than a lot of the other sectors. So it was one of the weaker sectors today after a big sell-off yesterday. But again, what concerns me with the chart of the XLV is just this huge overhead resistance. So this 102 to 104.50 range has been resistance a number of times, not just at the market peak. This sector actually peaked out in January. The market peaked out in February, had a lower high, but overall this has been validated a number of times, and you'd have to see some pretty significant upside momentum to take healthcare above that previous high. So what healthcare does, I think, is really interesting because it's emerged as significant leadership, a strong outperformer during this rally of the last month or so. I think technology is another important one to watch. Tech is one that, just like the S&P, broke down below the trend line yesterday, back up a little bit today. And so again, I think the question is, do we get the follow through? And I think we now have that line in the sand just below 84 on the XLK. That was the close yesterday on the big distribution. If we're able to hold that, that tells you that we're able to stabilize a little bit. If charts like this break that sort of a low, I think that tells you that the bear market rally is confirmed to be over in the short term. I think the short-term trend continues lower. So those are a couple. And then financials is the third one. Out of all of the sector charts, financials even looks more negative than energy. Energy is so beaten down. You could see there being a bid just because it's been so awful. But financials have really been underperforming as well. And year to date has been brutal. But you can see this looks very much like a bear flag pattern, this big sell-off, the parallel channel coming up. And again, we broke down through it. We actually closed above yesterday's close today, but I thought on the XLF, it's interesting to see we actually opened much higher. We actually closed lower. So financials actually telling you this is a bit of a weaker day than it looks like on the surface, which is kind of a telling divergence, I guess, from the overall signal of the day. Final one, I think staples is a really interesting one. Sold off from the 200-day moving average, up a little bit today, but really didn't get out of yesterday's range. So sort of stabilizing around that 50-day moving average. And again, unless you see staples recovering above the 200-day, I think for me, it's one more sector facing some pretty significant resistance above where we're at. Looking at some names, I thought it was interesting to see the stocks gaining most on the scooter rankings today were Twitter and Facebook, which is actually pretty interesting. Chipotle, when we get a little later to fishing for alpha, we'll look at the chart of Chipotle because we're looking for some breakouts, and that came on the screen. But you know, the stocks that were gaining in the scooter rankings, and again, this is the technical rating, a combination of a number of different technical factors, really based on momentum and what is strengthening Twitter and Facebook number 1 and 2 in terms of the biggest gainers. And you can see them kind of coming off the lower end of that channel and rallying back to the upper end of it. So certainly some flows into those names today, more than you saw from something like financials and elsewhere. Just finally, very quickly, I think it's worth noting that on a big up day, you also had gold miners and mining stocks up pretty big. A lot of the gold stocks breaking out today and following through from very nice trends up until now. But these are some of the biggest sectors, some of the ones you probably know. Restaurants and bars, with Chipotle's in that group. Semiconductors with Applied Materials is up there in one of the top names. So you have some others. You have internet stocks, E&P stocks within energy. So it's kind of an interesting mix of groups that are at the top gainers for the day, all outperforming the S&P on a nice up day. That's our market recap for today. We need to take a quick break. Be back with my guest, Jeff Hughes. We'll see you in a minute. Hey everyone, welcome back to the show. I'm your host, Dave Keller here at StockCharts.com. I want to remind you, please send your questions. Any questions are fair game about charts, about technical indicators, specific tickers, specific questions about the broader economic landscape. Everything is fair game. We're happy to answer any questions we have. We have some fantastic guests coming on the show to answer pretty much anything on your mind. So shoot us an email, thefinalbar@StockCharts.com, or look us up on Twitter @FinalBarSCTV. I'd love to answer your questions in our next mailbag segment. I want to bring on my guest, Jeff Hughes. We had a chance to sit down with you, Jeff. I want to say it was just before the holidays, was when we headed to Minneapolis to meet Ralph Acampora, interview him at his barn. And I was so glad that you and I sat down, and it's a pleasure to have you back on the show today.
Well, thanks for having me, Dave. It's a pleasure to be here.
Yeah, and I again have enjoyed following your work for quite a while. And the first chart you sent me was very interesting because it's looking at the cyclical nature within transports. What is this telling you here?
Well, you know, we've looked at a number of different indexes to come up with a good proxy for the economy, and it doesn't seem like we could find anything better than the transportation index after testing about 30 or so different global indexes. This really is probably the best illustration of what the economy is likely to do. What we're seeing right now is a breakdown from what we believe is a secular megatop, something that we've kind of tracked back to a 14.6-year cycle that I've got illustrated on the chart in gray, which overlays a more frequent 7.3-year cycle. We've seen several cyclical tops form in 2000, 2007, and again in 2018. But what we're seeing now, I think, is a much larger degree breakdown. And, you know, why not? I mean, historically, we've seen, recessions bring the transportations down some 50 to 60% in the past, and that's been relatively routine. And I don't think there's any doubt that we're in a recession right now. The real question is, will it morph into a depression? And from what we're seeing in the nature of the transportations as a cyclical proxy is a deep decline in its momentum, the lower window in the chart. And that's measuring its momentum on a 36-month basis. And we've got two big divergences that formed that gave us kind of a heads up that we could be in for some trouble, economically speaking. And I think the most recent series of events the COVID virus, black swan and all, has brought the global economy to a halt and has pushed momentum, economic momentum, which by um, you know, I guess extension, the transportation index momentum into deep negative territory, and we expect it to continue.
Now I'm very interested to see how you connect what you just described, which makes a ton of sense. And the cycles almost jump off the page at you. How does this relate to an Elliott Wave count looking at the industrials? Because we just talked about Dow theory on the show yesterday. So how does this relate to chart number 2?
Well, that's great. Well, there's been a lot of debate comparing, this bear market to 1987 crash and the 2000 great financial crisis.
Mhm.
And, the question being, are we going to get this quick V rebound, or is it going to be a long drawn out affair? Is it going to be an L-like sort of situation? And, I think, there's an old trader's maxim that comes to mind: when in doubt, zoom out. And so we've taken a look here at the 120-year history of the Dow Jones Industrial Average, and I've labeled on the chart a series of 1, 2, 3, 4, 5s at multiple degrees of trend in order to really illustrate how Elliott's wave theory might be relevant to this whole discussion. And as you can see, the 5-wave impulse progression is evident at, a variety of different degrees of trend, increasingly superior and subordinate degrees. And if we were to start just at the 1929 peak, we'd count that as a 1 and look at the 32 trough as a 2. And from there, we can see how we're going up 1, 2, 1, 2, 1, 2, 3, 4, 5, 3, 4, 5, 3, 4, 5, 3, 4, 5. And we've peaked on February 19th of this year at what I believe is wave 5 of a super cycle. This 5-wave motive wave progression that Elliott's described in his work that needs to be corrected. And if in fact we were to move to the next superior degree of trend, the entire super cycle would have to be corrected with some proportional correction. And if we take a look at what happened in the 29 to 32 affair, and I've kind of put a box around it in the lower left corner, and then compare that to the upper right corner, we've got kind of a similar sort of image facing us without the complete wipeout decline. And the question that I have, and it's just a question, I'm not making a forecast here, but I think it's a worthwhile question. Are we going to come back and retest this long-term trend that's evident by, basically connecting the dots of the lows in 74.82 back to the 1932-37 lows? And if we were to come back to that trend, it's interesting that it intersects with the lows in 2009 at kind of a convenient sort of angle. And that angle would bring it back about 78% if we're to pull all the way back to that trend line and support line. And if we look back to the 2932 collapse, we actually saw about an 89% pullback, but that support level came in at about 86%. So kind of in the same neighborhood.
No, we only have about 30 seconds left, Jeff, but I did want to move on to this last one because I was telling someone earlier about the Fidelity chart room, which I always enjoyed meeting with you when we were there together. But the history lesson of charts, and here you're providing a bit of a window into some of these historical pullbacks. Just very quickly, if you could, how does the current move relate to some of these previous sort of bear market phases?
Sure. So the S&P in the upper left-hand corner shows a decline of 35.4% and a rally of 31.3%. If we compare that to the NASDAQ 100 decline in 2000 to 2002, NASDAQ was down 39.8% in 2 months and then rallied in its second wave by 43% in 4 months. So kind of a similar sort of proportion. If we go down to the opposite lower left-hand corner, the Nikkei collapse in 1990 to 1992, the first wave down was about 28% decline, and then about an 18.5% rally over a couple of months. And then the final one is the 29 to 32 collapse in the Dow Jones. And the initial wave A down was about a 47.8% decline with a 31.9% rally over the next roughly 6 months before the knockout punch came. over the subsequent couple of years. And I think the real question here is, are the proportions of the current decline more like something we saw in 2008 or 1987, or is it more like the early stages of these, massive collapses of around 80% or so?
Jeff, I would not call this the most encouraging guest spot I could imagine, but I appreciate this. I mean, you are telling a fantastic story and drawing on some of the lessons of history here in a way that I hope a lot of people are really following. This is really well done, Jeff, and thank you so much for coming on the show today. Be safe, all right?
My pleasure, Dave. Same to you.
That was Jeff Hughes from JWH Investments outside of Minneapolis. I've known Jeff for a number of years and have just so much enjoyed watching how he has been approaching this period. I think those are some really interesting, thought-provoking charts about the potential and especially that last one about the strength of bear market rallies. I think that's something behaviorally that will always draw people in way past the point of where you should be thinking on the long side. So some really, really good charts there. We need to move right on to our next segment, though, which is fishing for alpha. So given this environment, and again, I think we've seen the writing on the wall of this current bear market rally, where does that leave us for stock ideas? And I would say this, what I would remind you is regardless of what the broader market is doing, if there's one thing I have learned, there is always an opportunity for stock picking. What I mean is when the market is tanking, there usually are at least a handful of stocks that are in fairly decent conditions, right? That are trading more toward the highs. And the same thing, when everything's kind of doing well, there are stocks that are underperforming. And so knowing how to identify some of those ideas, especially during a difficult time, can be really, really valuable. So today I just wanted to share an idea of a screen that I was looking at. This is using Bollinger Band. So I'm going to very quickly just show you what the screen is, show you the results, and I'll talk through what the Bollinger Bands actually mean and why it's an important screen. So what I'm basically saying here, and if you don't know our scanning engine, that's okay. If you look on our chart school pages, we have a lot of descriptions, explanations on how to use this. Also, my boss, Chip Anderson, has recorded some great deep dive episodes on the scan engine. I'd encourage you to check those out on our YouTube channel. And you can hear the man himself explain how it was designed. But here I'm basically looking for stocks with a minimum volume and market cap thresholds where they're basically closing above, crossing above the upper band. So I want things that are breaking above the upper Bollinger Band. So it's gone to a higher point than it has on average in recent days, recent weeks. These are the results of the stocks right now, just on that list that have come out. And I've done a couple different screens of it. This is an example of some of the names here. These are about 9 or 10 names that came out of the list earlier. I've sorted it on by sector. So you'll see some names you're probably familiar with, things like Pinterest, Snap, Chipotle, which I mentioned earlier, Domino's, and then you get into some healthcare names and so on. I'll show you some of the charts and we can talk about what these actually mean. We'll start with Pinterest, which is a fairly good example. So the way Bollinger Bands work, if you're not familiar, and again, our chart school article has a lot more color than I can give you on a quick show here. But it starts with the moving average here. I'm using just the 20-day simple moving average in the middle. That's just a regular moving average like you'd use on your charts. And then the green line represents 2 standard deviations above and below that moving average. So it's sort of like a standard deviation, but it moves along every day because it's basing it off of this moving average that tracks a moving window of 20 days at a time. So it's basically a rolling standard deviation, a rolling measure of volatility. And this was John Bollinger's improvement on percent channels that had been used before that. It was a way of making them a little more adaptive to the volatility in the underlying stock. So here we're looking for stocks like this right here, like Pinterest, that closed above the upper band or traded above the upper band. And the idea is if it goes above the upper band, that's 2 standard deviations around this average price, we're going up more than usual. So it's similar to looking for things that are overbought, looking at relative strength breakouts, just gives you a different way to screen through stocks and look for things that are sort of rotating more to the positive side. So what's interesting with Pinterest is you can see it bouncing off of sort of a trend line connecting the lows, but it's breaking to a new swing high. So while other stocks are sort of pulling back a little bit in the last couple of days, Pinterest actually breaking to new highs today in a pretty good way. Relative strength improving and not yet overbought. So it seems like it potentially has some further upside. This is SKM. It's a mobile telecom name within communication services. May not be as familiar, but I like names that are breaking above their most recent swing high and following through. And that's sort of what we saw with the gap up today and SKM. Snap is a name I'm sure many of you are familiar with. What's interesting with Snap is not only is it above the upper Bollinger Band, it's just today closed above its 200-day moving average for the first time since the sell-off last week in February. So that's a pretty nice barometer to get back above. As always, with something like this, you look for some sort of follow-through the next day. What concerns me about something like Snap, the relative strength has been fantastic, but it's overbought and it's nearing the significant resistance level. I think that's what concerns me. The chart of healthcare comes to mind. Stocks that have rallied a lot, but are right up against resistance. It's rare that you have things that are just long and strong up to new highs. Chipotle is another one that has done very well in recent weeks. You can see the relative strength has really exploded. And just this month, it's outperformed the S&P by about 30%. This is coming off of the swing low there the first week in April. But again, approaching significant resistance. It's now testing its February high around 940. So you'd want to see a break above there. This is a stock that was up 14% today. A lot of earnings and gaps happening today. Out of all these charts of stocks breaking above their upper Bollinger Bands, Domino's Pizza might be one of the better ones, I think, DPZ, because this is one that actually, again, if you didn't know that most stocks were sort of floundering, Domino's actually looks in a pretty decent shape. You had the big gap up and then the sell-off as the market sold off there the first couple of weeks in March. But since then, it's round trip back to its previous highs, back to a new 52-week high today. Relative strength improving, not yet overbought, and is actually in a pretty decent shape. Within healthcare, we'll just look at a couple more, and then we've got to wrap the show. BMRN is BioMarin Pharmaceuticals, name you may not be as familiar with, but again, nice run, not yet overbought, testing significant resistance. DGX, Quest Diagnostics, is actually a really interesting chart. This is where we're going to have to stop it. Testing the 200-day from below, actually traded above it today, got back below it, and as of the close, I didn't quite refresh it for the close there. Yep, you can see still closed below, back below the 50-day actually. Or sorry, this is back below the upper Bollinger Band. It was right at the edge when I ran the screen. So you'd want to see what the stock like this is. It able to hold above the 200-day, or is this the resistance that it sort of peters out in? So again, that screen was looking at stocks trading above their upper Bollinger Band. You can set that up using the scan editor. Or if you look at the predefined scans, this is actually one of the predefined ones, and you can do it by exchange. Look for stocks in New York, the NASDAQ that are in that condition. We need to wrap the show and go right to the three charts, and boy, it's probably going to be 1 minute, but we're going to get there. Chart number one is technology, the XLK. I talked earlier in the market recap about some of the sector charts that were really standing out to me, and I think the XLK is a really good one to watch right here, only because it's been such a good relative performer in uptrends and in downtrends. It outperformed going into the peak and also outperformed in the market sell-off. Since then, it's stabilized. It's been sort of a market performer, but holding up okay. And I think whether or not the XLK is able to hold up tells you a lot about what I think institutions are doing, because this is clearly where flows have been going. This is where people have been parking assets within equities to ride out any sort of bear market environment. So if there's a rotation here, especially on a relative basis, and there's a change in that dynamic, that would be a pretty different phase than we've seen in a while. Chart number two is Apple. So obviously one of the biggest technology names, but Apple is one big mega cap stock that has broken down through trendline support and now testing the first Fibonacci support. It's testing the 38.2% line. This is from the June to February rally. If Apple is able to hold that, that would probably make me feel a little better about a sell-off being less painful than I might expect. But if Apple's breaking down through that sort of support level, following through with a breakdown through the 200-day, I think we have to be concerned about much further downside for equities, more broadly speaking. Finally, we want to talk about just gold and silver stocks. The XAU is one of the most common gold stock indexes. As you can see, testing previous highs to a new 52-week closing high today, not quite an intraday high, but the relative strength has been exceptional. As I mentioned, most of the stocks making big gains in the scooter rankings today were in the gold mining space. Ladies and gentlemen, that's our show for today. I want to thank my guest, Jeff Hughes from JWH Investments, for joining us today, sharing some of his perspective. Send all your questions to us via email, thefinalbar@stockcharts.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.